Good morning. Welcome to Ares Capital Corporation's first quarter, March 31st, 2024 earnings conference call. At this time, all participants are in a listen-only mode. As a reminder, this conference is being recorded on Wednesday, May 1st, 2024. I will now turn the call over to Mr. John Stilmar, partner of Ares Public Markets Investor Relations.
Thank you. Let me start with some important reminders. Comments made during the course of this conference call and webcast and the accompanying documents contain forward-looking statements and are subject to risks and uncertainties. The company's actual results could differ materially from those expressed in such forward-looking statements for any reason, including those listed in its SEC filing. Ares Capital Corporation assumes no obligation to update any such forward-looking statements. Please also note that past performance or market information is not a guarantee of future results. During this conference call, the company may discuss certain non-GAAP measures as defined by SEC Regulation G, such as core earnings per share. The company believes that core EPS provides useful information to investors regarding financial performance because it's one method the company uses to measure its financial condition and results of operation. A reconciliation of GAAP net income per share, the most directly comparable GAAP financial measure, to core EPS can be found in the accompanying slide presentation for this call. In addition, reconciliation of these measures may also be found in our earnings release filed this morning with the SEC on Form 8-K. Certain information discussed in this conference call and the accompanying slide presentation, including information related to portfolio companies, was derived from third-party sources and has not been independently verified, and accordingly, the company makes no representation or warranty with respect to this information. The company's first quarter ended March 31st, 2024 earnings presentation can be found on the company's website at www.arescapitalcorp.com by clicking on First Quarter 2024 Earnings Presentation link of the homepage of the Investor Resources section. Ares Capital Corporation's earnings release and Form 10-Q are also available on the company's website. I'll now turn the call over to Kipp deVeer, Ares Capital Corporation's Chief Executive Officer. Kipp?
Thanks, John. Hello, everyone, and thanks for joining our earnings call today. I'm here with our co-presidents, Mitch Goldstein and Kort Schnabel, our Chief Operating Officer, Jana Markowitz, our Chief Financial Officer, Scott Lem, and other members of the management team. I'd like to start by welcoming Scott to his first earnings call with me in his new role as Chief Financial Officer. Scott's been with us for quite a while as a key business leader within our finance and accounting team. He's been at Ares for more than 20 years, so having him join us as our newly appointed CFO is great. We look forward to his continued contributions to Ares Capital. Scott and his promotion is just another example of our culture of continuing to promote our strongest players and shows the depth of the talent that exists at Ares. We still believe this differentiates us from other companies in the market. Now we'll move on to our results. This morning, we reported another quarter of strong core earnings of 59 cents per share. Our core earnings per share increased 3.5% from the prior year and were well above our 48 cents per share first quarter regular dividend. These results were driven by continued strong, attractive investment environment and the beneficial impact of higher base rates and attractive credit spreads. The strength of our earnings and the positive valuation momentum in our portfolio has also supported solid growth in our net asset value per share after paying a healthy level of regular dividends. Our NAV, which increased 6% year over year, reached another record of $19.53 per share. In the first quarter of 2024, while merger and acquisition activity levels remain relatively low, our share in the business continues to remain very strong. The banks are more active again, and this is generally good for all market participants, as the increased availability of capital typically brings out more M&A and adds confidence to companies seeking financing for transactions. The firming of the credit markets, the aging of significant amounts of private equity dry powder, and the continued pressures from LPs to return capital are all factors that support higher levels of activity. We're seeing signs of a pickup in transaction activity as evidenced by the $1.2 billion of commitments we've closed in the second quarter to date. While current market conditions are more competitive, this is not a new phenomenon for us. We have navigated many competitive markets over the past 2 decades, 2021 was the most recent that was similar. In these environments, we believe that our expansive direct origination capabilities that span the entirety of the middle market, from the low, middle, and upper segments, become even more valuable. And having a very large portfolio also helps to drive new investment activity. We continue to find attractive investments with compelling returns at historically lower levels of relative risk. And specifically for our originations in the first quarter, the weighted average LTV was below 40%. All-in yields were nearly 11%, and leverage is nearly a half a turn below our weighted average over the past 2 years. Furthermore, the originated yield per unit of leverage, which we view as one measure of the risk-adjusted return in the current rate environment, was 10% above the recent 2-year average. Our credit fundamentals across our portfolio are also indicating health and strength. Our portfolio companies showed organic EBITDA growth over the last 12 months of 10%, which is remarkable in today's economic environment. Interest coverage levels remain stable to slightly improved, and leverage levels ticked down. The annual EBITDA growth of our portfolio companies is more than double the annual growth of the companies in the S&P 500, which we sourced from data provided by S&P. On a final point, and as Scott will discuss further, the current market environment does enable us to raise capital more efficiently. So far this year, we've been active as an issuer in the unsecured notes market and the secured bank and CLO markets. We've issued in all these markets in what we believe are the tightest pricing levels amongst the BDCs. With that, let me turn the call over to Scott to provide more details on our financial results and some further thoughts on our balance sheet.
Thanks, Kip. I'm excited for the opportunity to serve as Ares Capital's CFO. This morning, we reported GAAP net income per share of 76 cents for the first quarter of 2024, compared to 72 cents in the prior quarter and 52 cents in the first quarter of 2023. As Kip stated, we also reported core earnings per share of 59 cents for the first quarter of 2024, compared to 63 cents in the prior quarter and 57 cents in the first quarter of 2023. Our investment income in the quarter was primarily driven by the continued benefits of higher base rates and structuring fees due to an improving investing environment. Our structuring fees decreased from the fourth quarter of 2023, given the usual seasonality in our business. They increased meaningfully from the first quarter of last year. Our stockholders' equity ended the quarter at $11.9 billion, or $19.53 per share, a new record high for us, which is a 1.5% increase per share over the prior quarter and nearly a 6% increase per share from a year ago. Our total portfolio at fair value at the end of the quarter was $23.1 billion, up from $22.9 billion at the end of the fourth quarter, largely driven by net unrealized gains from portfolio for the quarter. The weighted average yield on our debt and other income-producing securities at amortized cost was 12.4% at March 31st, 2024, which was down slightly from 12.5% at December 31st, 2023, but higher than the 12% at March 31st, 2023. In terms of our capitalization and liquidity, we have had a fairly active start to the year, making sure we are able to continue supporting our investment opportunities. So far this year, we have amended, extended, or raised over $7 billion of financing for ARCC. More specifically, in the first quarter, we issued $1 billion of unsecured notes at market-leading spreads and successfully settled our maturing $400 million of convertible notes in almost all newly issued shares, allowing us to retain the capital and further bolster our permanent equity capital base. In March, we also extended each of the revolving period and maturity date for our SMBC funding facility by 3 years. Post-quarter end, we renewed our largest revolving credit facility for another year, pushing it to a full 5-year maturity with the same pricing and terms. We also lowered the pricing on our BNP funding facility to SOFR plus 250 basis points. Finally, just last week, we priced our first on-balance sheet CLO in nearly 18 years. The blended pricing through the AA tranche on the $476 million in notes was SOFR plus 186 basis points, which we believe is one of the tightest executions amongst issuers in this part of the market. Closing is expected in the next few weeks, subject to customary closing conditions. This transaction allows us to further diversify our sources of committed debt financing at pricing levels currently below other forms of secured funding available in the market. Our overall liquidity position remains strong with approximately $6.3 billion of total available liquidity, including available cash and pro forma for all the post-quarter end transactions previously mentioned. We also ended the first quarter with a debt-to-equity ratio net of available cash of 0.95 times, as compared to 1.02 times a quarter ago, and our lowest net leverage ratio since the end of 2019. We believe our significant amount of dry powder positions us well to continue supporting our portfolio company commitments, remain active in the current investing environment, and eliminate any refinancing risk with respect to this year's remaining term debt maturities. Moving on to the dividend, we declared a second quarter 2024 dividend of 48 cents per share. This dividend is payable on June 28, 2024 to stockholders of record on June 14, 2024, and is consistent with our first quarter 2024 dividend. In terms of our taxable income spillover, we currently estimate that we ended 2023 with approximately $635 million or $1.05 per share for distribution to stockholders in 2024. This estimated spillover level is more than 2 times our current regular quarterly dividend, which we believe helps bring stability to our dividend. I will now turn the call over to Mitch to walk through our investment activities.
Thanks, Scott. I'm going to spend a few minutes providing more details on our investment activity, our portfolio performance, and our positioning for the first quarter. I will then conclude with an update on our post-quarter end activity, backlog, and pipeline. In the first quarter, our team originated approximately $3.6 billion of new investment commitments across 61 transactions. We continue to find compelling investments with attractive risk-adjusted returns despite some more competitive market conditions. We are generating double-digit yields with a weighted average LTV on our senior loan commitments at levels below 5 times debt to EBITDA. Excluding the $1.6 billion of loans on transactions we originated and distributed as agent, our commitments nearly tripled from the first quarter of 2023. The breadth of our sourcing capabilities allowed us to find value in companies with EBITDA from less than $15 million to over $600 million. Our extensive market coverage of companies of all sizes across the market enables us to source transactions in segments where we are seeing less competition or where we believe that we have a strong competitive advantage. Shifting to the portfolio, we ended the first quarter with a $23.1 billion portfolio at fair value, which grew 1% from the prior quarter and 9% from the prior year. The median EBITDA of our portfolio is $79 million, which reflects our presence in both the core middle market and the upper middle market. The weighted average LTM EBITDA growth of our portfolio of 10% that Kip mentioned is also broad-based. Importantly, in our portfolio, the size of a company has not been a driver of performance. Companies in our portfolio with $25 to $50 million of EBITDA have similar to or even higher growth rates as compared to companies with over $100 million of EBITDA. We believe company and industry selection, as well as our underwriting process, drive these types of positive results. In fact, our view is based on a study done by the Ares Quantitative Research Group that found that industry selection could account for approximately 500 basis points of difference in total for senior U.S. loan returns over more than a decade of investing. With respect to our credit performance, our weighted average portfolio grade of 3.1 remained unchanged from the prior quarter's level. Our non-accruals at cost ended the quarter at 1.7%, up slightly from the prior quarter, but lower than the same quarter a year ago. Our current non-accrual levels remains well below our 2.9% historical average since the Great Financial Crisis and the KBW BDC average of 3.8% for the same period. Our non-accrual rate at fair value remained consistent with last quarter's at 0.6%, which continues to be well below historical levels for our company. Another indicator of stable credit performance is the fact that our portfolio companies with a risk grade of 1 or 2 declined quarter over quarter. And finally, our portfolio quality is also reinforced by the substantial amount of equity invested in our companies, primarily by large and well-established private equity firms. At the end of the first quarter, the weighted average loan-to-value in the portfolio was 43%, which we believe gives us strong downside protection in our loans. As the market is starting to see more dispersion in results among managers, we believe our outperformance and credit position, including our significant diversification, differentiates us from our competition. Our strong and growing portfolio is well diversified across 510 different companies that span the market. The number of companies in our portfolio has increased 9% over the past year and 48% over the past 5 years, and the average hold size is only 0.2% at fair value. Excluding our investments in Ivy Hill and the SDLP, which we believe are well diversified on their own, no single investment accounts for more than 2% of the portfolio at fair value, and our top 10 largest investments totaled just 11% of the portfolio at fair value. We believe this degree of diversification further adds to the credit strength of our portfolio as it reduces the impact to the overall portfolio from any single negative credit event at an individual company. And finally, we have had an active start to the second quarter. From April 1st through April 24th, 2024, we made new investment commitments totaling $1.2 billion, of which $1.1 billion were funded. We exited or were repaid on $249 million of investment commitments, which resulted in us earning $1 million of net realized gains. As of April 24th, our backlog and pipeline stood at roughly $1.3 billion. Our backlog contains investments that are subject to approvals and documentation and may not close, or we may sell a portion of these investments post-closing. I will now turn the call back over to Kip for some closing remarks.
Thanks a lot, Mitch. In conclusion, we believe that the company is well positioned to navigate the opportunities ahead of us. At Ares Capital, we've navigated a variety of market environments, credit cycles, and interest rate cycles over our 20-year history with a cumulative average return on equity in the double digits. In our opinion, this is a very good time to be invested in a high-quality company focused on private credit. Our portfolio is performing well, and we believe that the potential returns on our investment remain compelling by historical standards. While we remain mindful of the potential for increased credit risks delivered with a higher for longer rate environment, we are highly diversified in defensively positioned companies, and our companies are demonstrating healthy and differentiated levels of growth. Our balance sheet and liquidity position remain strong, which we believe allows us to take advantage of this compelling new investment environment. Overall, we are confident that the factors that have driven our historical outperformance remain firmly in place, and as a result, we remain optimistic about our future prospects. As always, we appreciate you joining us today. We look forward to speaking with you next quarter. With that, operator, we can open the line for questions.
Thank you. At this time, if you'd like to ask a question, please press star, then 1 on your touch-tone phone. If you'd like to withdraw your question, please press star, then 2. Please note, as a courtesy to those who may wish to ask a question, please limit yourself to 1 question and a single follow-on. If you have additional questions, you may re-enter the queue. The investor relations team will be available to address any further questions at the conclusion of today's call. And we'll take our first question today from John Hecht with Jefferies.
Morning, guys. Thanks for taking my questions.
Hey, John.
Good morning. Thinking about a lot of activity in the quarter, both on the deployment and repayment side. I'm wondering, Kip, can you give us kind of an update on the syndicated and liquid loan markets and how they're influencing activity with you guys and elsewhere in the market?
Sure, John. I mean, I think it's not a huge driver, frankly, of what we're doing. There's been a lot of press, I'd say, about the banks returning to the market and perhaps a more risk-on way to try to arrange and underwrite and syndicate more traditional leveraged finance transactions. So that's certainly picked up. I think if you look specifically at our activity, I think it was about 70% of our new deals were coming from the existing portfolio, a little bit slower on the kind of new platform side, which was a little bit surprising for us. But, as I mentioned in the prepared remarks, we're pretty optimistic that, a handful of factors remain in play that should compel pretty good transaction activity this year.
Okay, and then you had obviously a lot of, again, deployment and repayment activity, and the capital structuring fees, were, as a percentage that were a little lower. Is there anything to read on that side, or is that just a function of the mix of originations?
It's more mixed than anything, although I will say we've noticed a little bit of pressure on upfront fees on new deals in the market simply because there aren't as many of them. So it's one of the levers that a borrower can pull to a certain degree to try to, achieve a more attractive financing, but it's more mixed than anything else.
It's also to add real quick, the numbers are probably a little bit inflated just because we also, as a role of agent, we did front some deals. So the true origination number is probably closer to $2 billion.
Right, you sort of have to back that number out.
Yeah, exactly.
So what was that? The true origination was what?
About $2 billion. About $1.5 billion was us as our role of agent fronting for some deals.
Gotcha. Okay.
Which happens from time to time. Yeah, it happens from time to time, just depending on what a syndicate composition looks like, who can fund it, closing, who can. It's sort of a technical point, but when you evaluate it, just make sure you look at the math in that light.
Okay, perfect. Thanks.
Thanks, John.
Our next question will come from Finian O'Shea with Wells Fargo.
Hey, everyone. Good morning. Hi, Kip. Can you, how are you? Can you talk about the environment for second lien, if the reduced exposure there is more market related or your portfolio positioning, and if that should continue, or if applicable, your ability to replace that with other forms of junior and structured equity? There's a lot of that in the portfolio, but wondering if there are sort of adequate volumes there if second lien meaningfully recedes. Thanks.
Yeah, and I'm going to have Court follow on a couple of thoughts on my side. I would say, look, when last year came around and kind of, the private credit players, us included, really were representing new deals in the market, almost everything that we were doing was getting done as a unitranche, regardless of size. And that, second lien, which has been a larger part of our investing effort, is just frankly not as prevalent in the market in terms of the mix of new deals. Does that come back, if some large deals actually get done as first lien in the syndicated market where we can provide junior capital? Maybe, I guess, we'll wait and see. As our second lien investing tends to emphasize much, much larger companies and is very often in line with the syndicated first lien. And that transaction just really hasn't been prevalent in the market, I'd say, for the last, call it 3, 6, 9 months. And we'll see where we go from here. The only other thing I'd add, and I'll take it to Court if he wants to add on, is we are seeing a lot of really good companies, to your point about junior capital investing and structured equity and all of that are performing well, but simply don't have the amount of cash flows they expected. So you see some senior lenders that are probably saying, wow, with higher rates, I'm not really deleveraging the way I was hoping to. And frankly, on the other side, the equity is looking for an extension of duration to accomplish what they want to achieve from an IRR perspective. So there is, we think, a pretty interesting opportunistic credit pipeline and funnel to do some of these deleveraging, junior capital deals. But hopefully that answers the question, Court, if you have anything to add.
No, Kip, I think you covered it all. Obviously, the return opportunities in the first lien market are super attractive. So regardless of the fact that there aren't as many second lien opportunities right now, we're not too bothered by that given the other opportunities that the market's showing us. But certainly more a function of what the market is giving rather than a purposeful change on our part.
Awesome, thanks. And I get a small follow-up, maybe sort of related. We noticed the special opportunities or ASOF group was moved over to credit, presumably under your domain, Kip. Is there any anticipated change there? Like maybe if you can go over your historical collaboration or co-investment with that unit and how might that change going forward? Thanks.
Yeah, it plays into the comment that I made about opportunistic credit, and I guess all I'd say is there's been a lot of collaboration over the years, and frankly, because that business was changing, I'd say a little bit in its opportunity to look more credit-facing and less like it should be attached to our private equity efforts. It was just a pretty simple move for us that we made kind of around year-end that became formal here at the end of the first quarter.
Thanks so much.
Thanks, man.
Our next question will come from Melissa Waddell with J.P. Morgan.
Good morning. Appreciate you taking my question. Noticed that dividend income was substantially higher quarter over quarter. As we think about the dividend income stream going forward, should we think about that as being aligned with the direction and change in interest rates and really consider that as much of a floating rate piece of the portfolio?
Yeah, hey, Melissa, thanks for the question. So it's two things, right? So Ivy Hill obviously represents, the lion's share of that dividend income. But I'd say for this quarter, it's higher because we actually took on a kind of one-time dividend from one of our equity investments. So that's probably why you see it tick up. I don't think there's a big change there away from maybe that one-time event, but we obviously benefit from having a diversified equity portfolio that can deliver, dividends from time to time.
Okay. And then I was hoping to follow up on one of the things that Scott touched on. Scott, hi, welcome. I look forward to working with you. The CLO issuance post quarter end, I think you mentioned it's been a while since you've done something like that. I was hoping you could talk about CLO issuance as part of the funding strategy and mix going forward. What role can that play? When will you flex that versus other secured or unsecured? Thank you.
Yeah, sure. So I think, just like one of our main themes for capital raising is diversity. And I think that, it was a pretty compelling opportunity for us. The spreads in that market are very attractive relative to other forms of secure financing. So I think as we're seeing also just as assets have moved from the BSL side to the private credit, the flow of debt capital in the CLO market's also moving that way. So it made a lot of sense for us to tap that market, to diversify funding sources at a pretty attractive spread. And, going forward, I think it's definitely part of our playbook now.
Our next question will come from Casey Alexander with Compass Point.
Yeah, hi, good morning, and thank you for taking my question. Scott did not mention, traditionally you guys mentioned what the spillover income is, but he didn't mention that. I was wondering what that number is, unless I missed it, which could be. But, you continue to pile up the spillover income quarter over quarter. At what point in time do you sort of reach the limit, or do you just consider it to be a cheap form of financing with the excise tax? But when do you sort of reach the limit, at which point in time you'd kind of be forced to make some special distributions?
Yeah, I mean, look, over the history of the company, Casey, I appreciate the question. We've obviously done specials in a whole host of different ways. And I said this in the past, we tend to really want to look at it on an annual basis because it's a tax calculation that we can really true up at the end of the year. And that's typically when we make determinations. But we're in a little bit of a tricky position, as you can probably appreciate, because while we have loads of earnings in excess of the regular dividend, the trajectory for rates going forward is reasonably uncertain. I think if you ask around a table, folks would have very different views. So combining that with the fact that we really aren't in a position, in my opinion anyway, where we want to put the company in a place where it would have to reduce its regular dividend, we just feel better materially out earning it today and building the NAV. So hopefully that answers the question, but it's a little bit tricky in a world where the rate environment changed quickly. We obviously wanted to recognize the much more substantial earnings power of the company when we increased the dividend to the 48. But yeah, it's something we talk about a lot. When's the right time? Do we get credit for specials? Do we not? All of that's very much in the dialogue with the management team and our board.
That's my only question. Thank you.
Okay, thanks.
Our next question will come from Paul Johnson with KBW.
Hey, good afternoon or good morning. Thanks for taking my questions. You touched on my question in terms of just kind of pressure on fee income, but is that something that you think you've experienced more on deals that you've refinanced in the market, or are you also seeing a little bit of fee compression on new platform deals as well?
Yeah, it's Kort Schnabel here. I would say it's primarily on existing transactions. New transactions are seeing some fee pressure, but as was mentioned before, the mix shift this quarter, I think we were 72% of our originations were to incumbent borrowers, and that was really the big driver of the numbers that you're seeing there. There is definitely some pressure across all fronts, but as is normally the case, existing portfolio companies don't deliver the same kind of fees as new borrowers do.
Appreciate that. And one last question I had, just kind of higher level, but I was wondering, kind of get your thoughts on a loan feature that we've heard more about, portability. If that's something that you've offered in any of your loans, if that's something that you come across, but any kind of thoughts on that feature would be nice to hear. Thanks.
Yeah, we've agreed to do it, a couple times. You put a lot of guardrails, obviously, around, when that financing can forward, i.e., to what counterparty would we be continuing to be involved with, what would be the fees, loan documentation, all sorts of other stuff. I actually think that's more of a feature, frankly, of last year where the financing environment felt more complicated. So having the value of an incumbent group kind of move over with a new equity check in a sponsor-to-sponsor deal is highly valuable, right, when the financing markets feel uncertain. I wouldn't say that the financing markets feel particularly uncertain today, so my guess is the request for portability asks would go down. But we'll see where we go from here.
Appreciate it. That's helpful. Congrats on a good quarter. Thanks, guys.
Thanks. Appreciate the questions.
Our next question will come from Mark Hughes with Truist.
Yeah, thank you. Good morning. You'd mentioned earlier in the call that your quantitative group determined that industry selection got you 500 basis points or could account for 500 basis points of outperformance. How stable is that over time, those industry groups? Do they migrate, or is it pretty steady?
This is Mitch, by the way. Yeah, our group, if you look at how they did the analysis, it was over an extended period of time in our portfolio. And if you have been following us for as long as we've been doing this, our the industry groups where we tend to invest has been pretty stable. So they were able to get that analytics through our portfolio over a very extended period of time.
And is it that the industry groups that you focused on have been reasonably stable, and that
if you look at our business services, if you look at our business services, our healthcare services, the industries where we invest really haven't changed a lot. We don't invest in cyclical businesses. We don't invest in low margin businesses. So they were able to, have a significant amount of data with which to make that analysis out of.
Yeah. Okay. Appreciate that. And then the exits seemed low for April. Anything to that, or just happened to be lower?
Yeah, I don't think there's anything to it. It's just a single month of data, so I wouldn't take too much away.
Very good. Thank you.
Thank you.
Our next question will come from Eric Zwick with Hovde Group.
Good morning. Wanted to start just maybe a quick follow-up. Kip, you mentioned earlier there's some uncertainty, I think, as we all know, with regard to the future direction of interest rates. And, just looking at slide 5, the percentage of fixed rate investments in the portfolio is up a little bit year over year, not a huge change by any means, but curious if that's reflective at all of either your preference or borrower preference, to maybe do floating versus fixed given their belief in the direction of interest rates, or if maybe that's more kind of natural migration, from quarter to quarter.
Yeah, I don't think there's anything particularly targeted there. I will say when we do some of our junior capital investing, we try to strike the right balance between floating and fixed rate, and frankly have a mix of both. But yeah, I think you're right that one borrower today may say I want fixed because I think we're higher for longer, and another borrower may say the exact opposite. So there's nothing particularly intentional there, and different situations just lead to different outcomes. I wouldn't take too much away.
Nothing intentional around the small change quarter to quarter, but definitely intentional in terms of having some fixed rate exposure in the portfolio, which I think is a differentiator for us versus others, in the market, and just gives us more ballast to operate through all different kinds of environments. Some of that fixed rate, as Kip mentioned, the junior capital, tying back to his comment about some of the opportunistic situations we're seeing for delevering balance sheets right now, given the higher rates. A lot of those are also fixed rate opportunities. So, that's probably driving a little bit of that tick up that you're seeing.
Thanks. I appreciate the color there. And just a bit of a follow-up as well on kind of your funding strategy today. You noticed or mentioned how active you've been during the first part of the year on the unsecured debt market. The spreads have been very attractive and tight for you all. So you're up to about, 78% of unsecured debt to total debt at this point. And wonder if you could just kind of refresh me on your bigger picture view of, over time, what your preferred mix is. And it sounds like, as you noted as well, CLOs have kind of re-entered the picture as well. So I'm just curious of your overall kind of bigger picture thoughts there.
Yeah, look, I think we're always, our investment grade rating is very important to us, and maintaining that, and definitely a big component of that is making sure we're majority unsecured. So I think, we're probably a little heavier unsecured at the moment than we would normally, but I think we're happy at the levels we're at now. And, I think doing the CLO and other forms of secure financing are also part of our, like I mentioned, part of our playbook. So we'll continue to probably do everything.
Great. Thanks for taking my questions today.
Thank you.
As a reminder, press star 1 if you have a question. Our next question will come from Robert Dodd with Raymond James.
Good morning, everybody. Last quarter, you gave us an update on the tail side of the portfolio. There were some liquidity pressures. Obviously, non-accruals are still really low. There's only one new one this quarter. If I look at the revolver and delayed draw utilization, it did go up a couple hundred basis points this quarter, but not a lot. So can you give us any more color on what the liquidity pressures are in the tail end of the portfolio? And do you think if rates do stay higher for longer into 2025, is there a point at which those liquidity pressures really become problematic?
Yeah, thanks for the question, Robert. So, we saw a modest, but I wouldn't say material uptick in just revolver drawdown. That probably does obviously tell us that there's likely, companies that obviously have less liquidity than they might like. And I mentioned this a bit earlier in the call. It's kind of a unique period, at least in my opinion, having done this a long time, because you have a lot of pretty strong company performance. And even with that strong company performance, you have capital structures that got set up that maybe can't live through, 5% base rates for a long period of time. And that's why you're seeing more equity and more structured equity come in to deleverage a lot of these situations, with potential for rates to remain, higher for longer, which frankly is kind of our baseline expectation around here. So we're managing the portfolio and thinking about risk as if we have higher base rates for longer. But again, none of our metrics have really shifted materially, right? Our non-accruals are up a touch, but materially below historical averages. And again, when you look at what we consider to be our underperformers and watch list, the ones and the twos, it's pretty consistent in terms of the percentage of the portfolio. So all in all, as a big macro overlay to thinking about the portfolio as a whole, we definitely take that into consideration, and that's how we think about managing the assets today, but it's not of particular concern.
Got it. Thank you. And one more, if I can. I mean, obviously, PIK and I don't necessarily have a huge problem with PIK, but PIK collections for the last couple of quarters have been quite low. Obviously, I think cash PIK collections is voluntary by the borrower rather than, at repayment. I mean, is there any trends there? I mean, it's volatile quarter to quarter anyway, but anything you're seeing from borrowers who might have in the past, 2 years ago, whatever, paid their PIK in cash and are electing to just hold the cash now instead?
I don't think there's any significant trend. I just looked at Scott and he whispered me the word, it's episodic, which I think is just, comes from quarter to quarter, and it's not all that easy to predict. I wouldn't take any big picture trend away from some of that data.
Yeah, Robert, it's Mitch. I think you have to look at when M&A picks up, a lot of our preferred, where we like to invest down the balance sheet, where we see real value, is based on exits, right? And when M&A picks up, you'll see a lot of that preferred come through. When M&A is slow, you'll see that just continue to stay out there, which we're happy to because the companies are performing.
Got it. Understood. Thank you.
Thank you.
This concludes our question and answer session. I'd like to turn the conference back over to Mr. Kipp deVeer for any closing remarks.
I'll just thank everybody for their participation today, and look forward to speaking to you all next quarter.
Thank you, ladies and gentlemen. This concludes our conference call for today. If you missed any part of today's call, an archived replay of the call will be available approximately 1 hour after the end of the call through May 30th at 5 p.m. Eastern Time to domestic callers by dialing 1-800-839-5635 and to international callers by dialing 1-402-220-2561. An archived replay will also be available on a webcast link located on the homepage of the Investor Resources section of Ares Capital's website.